Hello, everyone, and welcome to the Binance podcast. My name is Wei Zhou. I'm the Chief Financial Officer for Binance. So what I want to do with this show is to spend time talking to specialist entrepreneurs, scholars, influencers, basically leading people from a variety of industries. Hopefully, through these conversations, we can share insights on how blockchain is changing not just these different industries, but also in changing the world. Here's a quick disclaimer. All opinions expressed by our host and our guests on this podcast are merely their own opinions. They do not imply any endorsements or opinions of their companies. You should not take these opinions as specific investment advice, as you will be solely responsible for your own investment. Hey everyone, and welcome back to the latest edition of the Binance podcast. Today, I actually have a really awesome guest, mainly because one of the key themes behind the Binance podcast is we want to bring in experts and professionals who have joined the cryptocurrency space from their own fields, where they've basically made a really successful name or successful career for themselves prior to their entering the cryptocurrency space. And in conjunction with that, bringing their experience into this space. So today, I'm joined by Ed Tolson, who's the founder of Kbit. For those who don't know, Kbit has actually been pretty stealth, but they're a high-frequency trading firm that's focused on the trading of crypto and crypto derivatives with basically really high trading volume, with over $1 billion a month. So that's quite a bit of volume. Ed to come here, introduce himself. Basically, his background is that, he's a comp sci guy from MIT, and then has basically, prior to joining the crypto world, spent about 20 plus years in the quant trading space, focusing primarily in the equity markets. And he founded Kbit in 2017. And then Ed, I'll let you jump in here and I've said my bit in terms of your background, but anything you want to add in terms of your introduction, and then, we'll jump in from there.
Yeah, that's a pretty good job. Thanks for having me. Happy to be here today. Yeah, so I'm a computer scientist at MIT and then kind of stumbled into finance just almost 20 years ago and have been applying computer science to algorithmic trading for almost 20 years now in terms of what we would call high and medium frequency strategies in the equity markets.
And just, I think for people who don't know what high frequency trading is, as a HFT fund or investor, what do you do on a daily basis? I think in particular in your previous job when you're trading equity.
Yeah, that's a good question. So we are not manually making trades. Just in case it's not clear, all the trading is done by computers. So what we're doing is writing the software, laying the pipes, collecting market data, and then doing research. So you might have an idea that a certain strategy will be profitable. So then you do some research on the market data you have and see how it looks. Try to incorporate new things like that into your trading models. So the day-to-day is like a mix of kind of making sure the trading system's running correctly and doing research to continuously kind of improve the trading system.
And then you've been doing that for 20 years in the equity markets, it seems. And what were some of the major trends? Because I know the Michael Lewis book with regards to sort of the rise of the HFT trading and in terms of a lot of the proprietary systems that we've seen, coming out of Citadel and Renaissance and those guys. Now they make up those type of firms now make up the bulk of trading that takes place in the traditional equity markets. I think you seem to be like the guy that part of that trend. Like, what was the evolution of that in the equity markets you saw?
Yeah, I kind of stumbled in right at the beginning of that. I think I first started poking around in 1999 while I was still in school. Back then in U.S. stock markets, a typical bid-offer spread was 25 cents or 12.5 cents, something like that on a $25 stock. So, it could be a 1% bid-offer spread. And a lot of trading was done manual. There were like farms of manual day trading companies, where people went in every day and like click buttons to do trading. I think computers kind of took that over. So computers took over the function of capturing the bid offer spread and narrowing the bid offer spread and identifying and capturing like very short-term trends in the market, signals that are in the order book or signals that are in short-term price movements or signals from other markets that are coming in. So whereas people used to do that in 1999 and still be able to do it profitably, there's no way you can do that today. Today, the US equity market in terms of high frequency is, as you mentioned, hyper saturated, hyper invested. So much capital has been invested and human capital has been invested that it's a very efficient market. Spreads are tiny, spreads are a penny. And that's been the trend, is this kind of a lot of investment and most of the inefficiencies have been wrung out. We could talk about the different types of strategies there. The Michael Lewis book is obviously a really interesting showcase of a predatory strategy.
Yeah, but I think that's just one type, right? Because there's multiple.
Yeah, absolutely.
I know there's global macro strategies you can take in terms of industry sectors, because a lot of it is more about just capturing the inefficiencies in the marketplace.
Yeah, so we tend to divide these strategies up, and the terminology is usually like high frequency, medium frequency, low frequency. And high frequency is your forecast for a given position is like seconds, minutes, at most hours, and then medium frequency would be more like minutes, hours to days, and then a lower frequency would be like you're holding positions for weeks or months. And all of those are different types of what we would call systematic or quantitative strategies, which means that they should be automated. They're trading done by computers, where humans have done research and then decided, okay, there are certain patterns or ways to capture inefficiencies in the market. And so all those markets are pretty saturated in the US equities markets for sure.
And from that perspective, are your sort of trading software plugged in? How plugged in are you to sort of the exchange themselves?
In the crypto space, I mean, yeah, we're
in the equity space.
Yeah, so co-location is the thing in the equity space, right? Because nanoseconds, microseconds, the market is so saturated that to be competitive on a short-term time frame, you have to be competing in the microsecond and nanosecond range. And if something happens on a market in Chicago, there's a race for that information to make its way to New York and be reflected in the different market in New York. So if something happens in a futures market or an options market in Chicago, there's a race basically competing down the speed of light to get that information to New York. So it's hyper co-location. So much capital has been invested in that.
Mm-hmm. And does that exist for global equities, do you feel like? Or is it primarily just US?
I think it exists, but to a much lesser degree. For sure, the European markets and the Asian markets co-location is a thing. I think less capital has been invested. The trading volume's lower, market caps, total market cap, US total market cap is a pretty big percentage of world market cap. So, most of the investment's been done in the US.
Okay. For you personally, when did you start dabble, I think, into crypto?
Well, so I've been a crypto enthusiast since as long as I heard about it. I share the...
Okay, so you're an early Bitcoiner. Okay, I got you.
Yeah, I share what I consider to be the founding kind of principle, or the Satoshi white paper principle, that government money is unjust and we need alternatives. And so for that reason, I've been following it from, as soon as I heard about it. But I only started trading it in 2017. So I kind of stumbled in. I was on a non-com period from my last job, and was just looking for a project to keep interested. So I was like, hey, I'll try some high frequency strategies in crypto. Really didn't expect much to come of it, but the timing was perfect, obviously, with what happened in 2017, and so it developed into a real business.
Back then, 2017, I think, what exchanges existed back then? Like, what exchanges did you trade on back then?
I struggle to remember, because the exchanges before Binance, kind of the spot market exchanges kind of popped and then came back down. So I think it was, you know what it was, is Chinese exchanges were dominant back then. So when I first started, I was trading on mainland Chinese exchanges. So it was OKCoin at the time. There was one called CHBTC.
Mm-hmm. How applicable then were some of your strategies from the equity world applicable to the crypto market back then, and maybe even evolution of that to today?
Yeah, I started from scratch. So I didn't take like models that I had and, kind of refit them to the crypto market. But I've built models like this so many times that I can build them very quickly and kind of start from scratch. So I started from a crypto kind of centric place, and I started very simply. I started with strategies to like capture the bid offer spread, which is like the most basic kind of market making strategy. And then, kind of expanded from there. So the concepts are the same. The concepts of like where profits come from in the crypto markets are the same. And it's basically like there are four kind of sources of short-term alpha or short-term profit, which is like the bid offer spread, discrepancies between different venues, which in this case would be different exchanges, having some kind of a short-term price forecast, so where you think the price is going. And then the fourth one would be some kind of front running, which obviously we don't do, but we can, talk about what that is as well. So I think those are the same sources in crypto as in the equity market for short-term profit. But yeah, I started building the models from scratch. And there's enough nuances to the crypto markets that it makes sense to start from scratch. You have to start recording market data from scratch.
Then that comes down to sort of the second big part of the question is, in addition to strategy, what are some of the technology requirements then in terms of starting your own crypto sort of high frequency trading business?
Yeah, that's right. We're like market data consumers. We live on market data. So you have to start recording market data as soon as you can. Like the rule number one in quant trading is you record everything and you never delete anything. Kind of the first thing we do if there's a new exchange that has interest or whatever, we start recording all the data and we save it forever. So we get like huge bills in terms of like database and storage every month. And then in crypto in particular is this uniquely kind of global market and 24/7 market. So we're running virtual servers in the cloud, around the world 24/7. So we're primarily in AWS, though we do use some other providers. And so we're running AWS servers in, like all these different regions in Asia and in Europe and in the US and in Canada. Those are the key kind of requirements.
That touches on a really different aspect, I think, of the cryptocurrency trading business, even for exchanges like Binance. It does operate 24/7. There's no breaks. I would say that's something. I would say that is that probably one of the biggest differences then in the equity, in that at least you get some time off.
Yeah, it's a key difference. I don't think it's the biggest one, but it's a huge difference. I mean, the number of hours that the U.S. stock market is open is like 6.5 times 5, whatever that is, 32.5. Versus like 100 and however many hours in a week. So there's a huge, the markets are open a much longer period, every week, and it's 24/7. So you don't get a break to, do system upgrades and things like that. And I know, that's a challenge for Binance and every other exchange out there as well. And it's equally a challenge for us. We have to do upgrades on the fly. We have to find safe ways to do upgrades during trading hours.
So you don't turn your software off at all then?
Yeah, correct. We're always in the market. I don't think we've ever not been in the market since I started. So if we have tech issues, we might be down on one exchange or something like that, but we're more or less always in the market. And it also means like from a support coverage standpoint, you've got this nightmare where you need not only 24/5 support, but like 24/7, weekend nights, we trade every holiday overnight. It's kind of a nightmare and it can be very taxing on your personal and social life.
Tell me about that. Then it goes down outside of the personal challenges. I know a lot of the infrastructure, I think, in crypto is still being built, right? Like, because a lot of the infrastructure, a lot of it, like, at least for me in the early days, if your API works 24/7, then you're like, oh, great, right? Not even to mention if you do have customer support 24/7. But just in terms of like infrastructure wise, have you seen any improvements in there? I mean, obviously we've seen improvements, but what challenges does it remain for this business to really start to take off?
Yeah, there are tons. I would say, generally speaking, a lot of the exchanges were founded by people that didn't have much background in finance, and Binance is obviously an exception to that. And so there were a lot of challenges around the tech infrastructure, integrating with exchanges, API nightmares. Binance is a rare exception that kind of got their API right on the first version where, like, for instance, they push order updates to us instead of us having to poll for order updates and things like that. No, a lot of other exchanges have come a long way in the meanwhile. But the key kind of structural thing that remains, and I don't know how to solve this, but the key problem that remains is that the exchange is everything. In the equities world, the exchange functions would be at least 3 different companies, if not more, which is like the matching engine, the settlement layer, and let's say the front end. Like those would all be different people and different providers, and you can mix and match in the equities world. That puts extra burden on the exchange, and it also puts like extra burden on us. Like we have all these additional complexities created by that.
That speaks to things then, I think, right? First is, for example, right now, in the equity market, maybe just plugged into, NASDAQ, NYSE, and then maybe like Chicago Mercantile. But here, you're probably plugged into like the top 30, 40, 50 exchanges across the board. Like, how do you manage that?
Yeah, that's right. Yeah. So we're plugged into, we've integrated with 40 spot exchanges, probably 10 derivative exchanges. Yeah. And they're all doing API upgrades whenever they're doing them, and we have to stay on top of that. They have outages at different times or scheduled maintenance at different times, and we have to stay on top of that. So it definitely creates operational overhead.
Speaking of sort of the different roles for Binance, for example, right? Like custody is something that people talk about, centralized exchanges take custody, but I would prefer not to because it's not like I'm getting paid to take custody, right? Whereas all the risk is on the exchanges, but we're not being compensated for that's not priced in. Right. So that's why I think for Binance, at least, we've been trying to, or at least we've been, pushing for the DEX, which is a custody-less, right? You let customers, take their own custody. Would that be something that would be of interest, or that would be like a firm like you, that would be one of the things that you would try?
It's really interesting to hear you say that, because from our standpoint, we're always viewing, oh man, the exchange has custody of our funds, and it's a huge hassle for us, and we're so dependent on them, right? Like if they freeze withdrawals, we're screwed. We're short capital for a week or whatever it is. But no, now I see it from your side, which is like, when you take a loss, you're compensating the customers. You're taking that out of pocket, and you're not getting compensated for that. You're not charged. You're not collecting a settlement, 1% a year or anything like that, or a custody 1% a year or anything like that, or a settlement fee for that matter. And so we would love any solution to that problem. We don't get, in some ways, we're not getting compensated for the counterparty exposure that we're taking there. And kind of more importantly, it increases the amount of capital that we need. So like in the old market, let's just say there was an arbitrage between the NASDAQ and the New York Stock Exchange, right? So you buy IBM on NASDAQ and you sell a short on the New York Stock Exchange. You don't have to do anything else. And that's an extremely capital efficient trade. You almost need zero capital for that trade if you close the position intraday even on a different exchange. If we were to do the equivalent of that between Binance and a Binance competitor, we would have to have Bitcoin sitting on Binance, Bitcoin sitting on the competitor, and then do the trade. And then so we have to keep capital locked up on both exchanges at the same time. So it makes us very capital inefficient compared to an analogous business in the equities market.
That's really interesting because basically there's no capital efficiency. Like for you to trade it, maybe that's a product offering down the road, right?
Yeah, so margin capabilities help, but really what you would need is some kind of like clearing provider, like a third-party clearing provider that sits behind some of the exchanges or partner with some of the exchanges and is kind of clearing things behind. So I can buy Bitcoin on Binance and sell it somewhere else and just get that cleared as a single trade that doesn't require much capital.
It's just a ledger then. It was basically you have to keep a ledger, and then there's someone that actually, the fund holder, the custody holder, actually runs the larger ledger. They have to true up that ledger on a daily basis.
Yeah, you become the exchange. You become the matching engine, the exchange, and not the settlement and custody.
That's interesting. I'll jump into sort of a different topic then. If you look at from 17 today, you've gone through sort of, I would say, one major bull market and a little mini bull market the last few months, and then probably like one major bearish cycle. Has that changed your sort of like overall strategy, or does your overall strategy change during that time?
No, and we try to run hedged. So our baseline position, we try to be kind of flat market exposure. So in the equity market, you would enter the day, flat everything, and then you might short IBM on NASDAQ and buy it on the NYSE, and you're flat again. And so we're trying to have that approach, although obviously it's a challenge in the crypto markets, both because of the problem we just talked about and because there's nowhere for me to borrow Dogecoin, and so that I can short it intraday. So
do you take any positional bets then at all?
So we're trying not to. So we have a sort of baseline position, and we have a hedging strategy to kind of make our baseline market exposure as flat as possible. And so if we can't borrow Dogecoin, less incentivized to trade it, and we have to trade it at a disadvantage. So we have to trade it at we need a higher return on capital to trade it, so we need a higher profitability to trade it. But we might still try to trade it and short something else in place of it.
I think come on to sort of last portion of our chat. What do you see sort of in terms of on the horizon, or rather, and lastly, sort of what do you look for? What are some of the key offerings that you're looking forward to at Binance?
Yeah, so we talked a lot about the settlement and custody. So if you guys can solve that one, that would be amazing. I think that would make the markets much more efficient. So I won't rehash that one. I think coin lending and expanding margin capabilities are huge. They make your market more efficient. They make your spreads tighter. For high frequency firms like us, they're huge for all those reasons we just talked about, so that we can short sell Doge and not have to take a lot of risk in doing that. And it reduces our capital needs, the amount of capital we have to tie up. So we look forward to you guys continuing to grow out your margin capabilities. And we would really welcome some kind of coin borrowing, coin lending solution as well.
Okay. Cool. What do you see in terms of competition then, in your business? Because I know for our business, competition is super, super tight right now.
Yeah, it's a little harder to tell because firms like mine aren't really public unless they, so there are a lot of firms doing this type of business for sure, and that I've become aware of. So I know it's a competitive market, and I think it's probably increasing. I think as crypto has showed that it's resilient, that it's survived the bear market. I think there are even more firms entering. So I know there are a ton of firms. I think the way a little bit different is We trade really deep alts. So we trade almost 400 cryptos today. And so we're able to, make markets on anything on Binance or, really kind of deep alt coverage like that.
Wow, that's pretty amazing. You guys are really market movers in this. Yeah, for me, I don't get that involved in this aspect of the business. My focus is a little bit more strategy, growing up, developing our fiat business. So at the same time, helping us to meet a lot of the regulations and as sort of the regulations tighten up in different marketplaces. So for me, it's actually very refreshing to hear that a lot of the traditional equity style sort of is applicable. I do feel that the volume in this business is only going to grow as sort of like more people come in and as I would say even the players get more sophisticated.
Yeah, absolutely, for sure. Yeah, it's a growing asset class. And as market cap grows and as volume grows, that's going to attract more of the traditional HFT firms into the market.
Yeah, and one of the things that we've been trying to do is basically introducing more, I would say, high quality tokens as well, our Launchpad programs. And because I think only then do you really grow the asset class. Some of them might make it in the long run, some of them might not, but at least I think it does provide a different path of fundraising on the blockchain, and people are continuing to do it. So we still got to continue to feed the beast. Thank you guys for listening in. I really, really say a big shout out. Thanks to Ed to share, his knowledge and his experience here with us. For me, at least, it's been extremely enlightening. And then we look forward to having you guys join us again on the next Binance podcast. Thank you very much, Ed.
Thanks, Waves. Nice chatting.
Thank you for listening. I hope you enjoyed this interview as much as I did. If you like this show, please share this episode on Twitter, Facebook, Telegram, WeChat, or any other social media platforms. Please don't forget to subscribe to the Binance podcast, and see you next time.